Very early good afternoon and a warm welcome to all the members in this VCM on valuation and due diligence. And I especially welcome CA Anil Bhandari, the chairman of the Valuation Standard Board, CA MP Vijay Kumar, the vice chairperson of the Valuation Standard Board, the colleague in the board, Sarika Singhal, and our guest speaker for today, CA Atul Mehta ji. Now, the topic is simple yet very quixotic in the sense while the English meaning of due diligence would be to take ordinary care, but in terms of the law, because if certain conduct, certain things are to be prescribed, it has to be tested against a standard, a legal standard. And what is that legal standard? Legal standard is possibly we are talking of a reasonable care and caution. Reasonable care and caution to be exercised a person who is duty bound under the law to protect the stakeholder for incurring any liability. Because ultimately, what is the purpose of any such exercise? Identifying, assessing, and ultimately mitigating the risk by assessing, identifying, and accounting for the things which may cause any liability. Now, because in India we follow the common law traditions and the breach of common law duty, because we say that what distinguishes a general avocation from a profession, the profession which are licensed ones. So there is under the law, there is a duty imposed that there would be a conduct which is reasonable and prudent and which takes care of due skills, diligence, and while there would be many scenarios like due diligence for administrative matters, financial assets, the environment, strategic fit. Possibly if we make a comparison between what you call the test of due diligence under the, I'll give you an example under the Indian Penal Code. The section 304A coming into play very recently for negligence standards. And in terms of the negligence, there are three aspects built in: omission or commission. Non-feasance, omission, we omit something; misfeasance, do something which should have been done properly; or malfeasance, do something which should not have been done in the first place itself. And while under the criminal law, you have doctrines like res ipsa loquitur, that in an ordinary situation, something would not have occurred if there had not been that negligence. Now, various statutes in India, like I made a reference to the Indian Penal Code, where the test is, I'll just make that reference. Whosoever causes death with the intention of causing death, or with the intention of causing such injury as is likely to cause death, or with the knowledge that he by such an act is likely to cause. So importing that into economic laws, I think many of the Indian statutes like the SCRA or the Income Tax Act, they have made reference to the provisions of due diligence. Under the Transfer of Property Act, the legal standard is of notice, which is the general information. Now, what it means, since we are talking of this VCM in particular context of valuation, now in the criminal system, you have what is the mens rea, but in civil standards, in administrative law, at least the IBC code, it specifically lays down under the section 208 what is a reasonable care and due diligence in respect of a insolvency professional. And if we look at very recent judgment by the Delhi High Court in the case of Cushman and Wakefield, so the court has laid down that if we are talking of a stream of valuation professionals, The focus has to be on the professional skills of the individuals rather than the business venture. And in terms of the valuation rule, the rule 3 talking about a fit and proper person, rule 7 talking about abidance to the code of conduct. And if we look at the model code of conduct, there is a responsibility cast in terms of professional competence and due care. So I think we come back to the same scenario, because what as a professional we are trying to do different as a licensed profession. So licensed profession is abidance by certain code of conduct, and looking at the stream of the scope of valuation under the valuation rules. We have things like caveat, limitations, disclaimers, major factors which were taken into account, procedures taken into account for coming out with the valuation. So overall, I think since the jurisprudence for valuation related matters, the case laws, they are yet emerging. So I think we have a very eminent and a learned speaker today. Let me introduce him, CA Atul Mehta, who is a member of the Institute, graduate from Delhi University. And in fact, he has been into due diligence engagements in private equity, venture capital and corporate clients, not only in India, but has overseas experience also. So I think he is the best person to apprise the audience on the very finer nuances of what all due diligence in regard to valuation is, because it is more than an abstract science. It is a socio-economic law in which many of the problem statements, hypotheses, and the data gathering, it depends on the professional competence and the skills of the valuation professional. So with these words, may I now request the chairman of the session, C. Anil Bhandari, to carry forward this session. In fact, the heuristic model in these sessions is altogether different, and we do not have any defined boundaries, and we talk about certain real life situations, and which the chairman and co-chairman along with the speaker carry forward. So over to you, C. Anil Bhandari ji, to carry forward the proceedings.
Well, thank you, Rakesh ji. Thank you so much. I think today you've taken us through a roller coaster ride. I said last time that, whenever I listen to you, you sound like a Harvard or a Purdue professor. So today, I think you took us on a roller coaster ride from the legal terminologies of due diligence all the way to, business and then valuation and how do you do diligence. So thank you so much, and a very warm welcome to Atul Mehta ji. I think we have a fantastic speaker today and a guest to discuss due diligence with us. And MPB, correct me if I'm wrong, if I'm not wrong, but the fundamental aspects of this topic was not only to limit due diligence only from a valuation perspective, but I would be very keen to hear, Atul, from financial due diligence to a business due diligence. And of course, maybe if you can touch about some aspects of legal due diligence, especially with the perspective that this country has gone crazy in the last one month or 2 months from a valuation and new businesses coming up and Zomatos of the world coming up. So this is absolutely a fantastic time, in spite of the fact that we are in a COVID situation. I think that is well generated everywhere. And Atul tries to make sure that the well generated is reasonable within the ambit of due diligence. And he tries to make sure that, all that is put on the paper has some sanity behind it. So I think this is going to be a fantastic conversation. So once again, a very warm welcome to MPV, my colleague and co-chair of the Valuation Standards Board. And I'm quickly putting across to him to make sure that we have a very engaging discussion.
So thanks, Anil. In fact, I just want to add a sentence to what you mentioned about Rakesh. In fact, each Sunday I listen to him. For me, it's personal.
Yeah, I think we should have one session from Rakesh ji only.
Exactly.
One of these Sundays, right?
As I want to say that there's so much of learning. What I like is the amount of preparation he does for this 10 minutes of introduction. I think credit to him. What I see is he values the time of all the members, ensures he's preparing very.
I love this discussion on the brand valuation, the brand introduction that he did, MPV. I think, I'm not sure. Yeah, this is recorded, right, Sarika? So I might want to go through it. And he really sounded like a Purdue professor. Yeah. Anyway. fantastic it was. Anyway, back to you, MP. Sorry about that. Yeah.
Thanks, Rakesh. I think sincere thanks for the kind of preparation you do and set the context. Atul, thanks for accepting our invite.
Vice Chair, let me say that value is a relative concept, and amongst us, we are trying to create value for time and the resources which the members are trying to think, and we try to bring in a multidisciplinary perspective in the entire discussion. Thank you.
Thank you.
Thank you. So Atul actually comes with a very enviable experience of due diligence, including cross-border transactions and also a stint in the Bay Area, and now almost name investor or a fund or a venture capitalist. He's done due diligence on behalf of them, either buy side or sell side, and I don't think we could have had a better person to share experience with us. So welcome, Atul, and without much ado, let me begin with the first question to you. And as we progress, we'll have lots of questions from our participants. And personally, I've been actually very surprised about the number of questions, and more importantly, the quality of questions that the members have been asking. We'll try our best to share those questions to you as the discussion progresses. So the first thing to begin with, Atul, is can you explain in simple words the interplay between a valuation exercise and a due diligence exercise? Are they quite independent, or there's an interplay, and how does it operate if so?
Thanks a lot, MP Sir, Anil, Rakesh, and Sarika.
Atul, please feel free to call me as MPB or Vijay.
I love the way everybody calls you Sir MPB. I mean, this is just out of the world, man. Last time I said, Atul, it's known in the South that if a student comes and touches MPB, if he just shake hands, he doesn't take a bath for 10 days. Yeah. I don't know whether you're aware about it or not. Fantastic fan following. Yeah. So Sir is better, MPB. MPB Sir is better. I also call you Sir. Yeah. Yeah, sorry, Atul. Sorry about that. I couldn't resist myself.
Absolutely. So, thanks a lot again. Just, in terms of the first question, you're absolutely right. Valuation and diligence are as integrated and as interconnected as can be. To put it simply, a proper valuation uses the information that is obtained during the due diligence phase as support. Whenever we are evaluating a business, it should be based on one, accurate information, as Rakesh indicated, and second is other factors. Whether it's economy, historical earnings, cash flow, potential profit of the business, future growth, any legal implications. All these need to be factored in while doing a valuation. Typically, what will happen is that all the inputs from the diligence will be factored into what we call a financial model. And that financial model is an important source for doing the valuation. We'll expand on each one of these things as we go along, but these are some of the things. I think some of the points that, as we go along, just keep in mind is one term is financial model, and there'll be 3-4 other terms which I'll just lay down as we go along. So if we can just keep those at the back of your head, and it'll just help simplify the entire discussion.
So Atul, as far as the valuation is concerned, I think you introduced it so nicely. We also have the ICAI Valuation Standard 202, which deals with analysis evaluation, which in a sense actually is the due diligence. Corresponding international standards, some of them refer to it as investigation, but I think on substantial deliberation, we choose to avoid the word investigation and instead use the word analysis. Now, maybe sometime as we progress, you may like to touch upon the Institute Valuation Standard 202. Now, as far as the valuation is concerned and the due diligence, is the due diligence done prior and then valuation comes in? or valuation is done, validated by a due diligence subsequently and adjusted. I guess both situations exist. It depends on how the party is willing to proceed further. Can you share your experience and some guidance to our members?
No, so you're absolutely right. Very valid question in terms of what comes first, whether it's valuation or it's due diligence. If I just just step back, look at a normal transaction, what will happen is, either there's a company which is in the process of being sold, or it's in the process of raising money. That's when a diligence will be done. Now, in the first stage, what will happen is that the company will share some information with the prospective buyer or the investor. Now, at this stage, the investor, I'll use the term investor and buyer as one term. They will do some initial analysis on the company, okay? And that initial analysis or diligence will be more in terms of looking at the market, future growth prospects, high-level review of the financials, whether the legal framework seems to be okay or not. That basis, they will put out what is called a term sheet or a letter of intent. Now, the important part is that this term sheet or the letter of intent is non-binding. It is non-binding and it is subject to detailed diligence. More often than not, the term sheet will lay down that the valuation and the terms that are given in the term sheet are subject to legal diligence, financial diligence, tax diligence, technology diligence, market diligence, and the entire gamut. So that's where then, once the diligence is complete, that's where it becomes binding in nature. The valuation and the terms will become binding in nature. The reason why I mentioned this is that subsequent to the diligence, the buyer or the investor will be able to take a call as to whether there are any changes required in the valuation, or there are any terms to be put in the transaction documents. So just to answer your question, there is limited amount of diligence that is done
He lost you a little bit, Atul. We lost your voice a little bit. So yeah.
Okay. So just, is it better now?
Yeah, much better. Perfect.
Okay.
Perfect.
Okay. So what I was saying was that in most cases, there'll be a limited diligence that will be done prior to issuing the term sheet. And then the term sheet is, more often than not, it is non-binding in nature. And post issue of the term sheet, there'll be a detailed diligence that will be done, which will determine the final valuation and the terms of the transaction.
Atul, you mentioned over the last 2 minutes while you were responding to the question about financial due diligence, tax diligence, legal diligence, and so on. Can you briefly articulate for us the different types of due diligence which are there, and the key points which a valuer needs to keep in mind as to the inputs he should take from those respective diligences which are done, the financial one, the taxation one, legal one, so on and so forth?
Got it. So, it's interesting. Over the last so many years, the entire gamut of different types of diligences has been increasing. Okay. The other interesting part is that the time that is given to do all this is also is decreasing at the same time. So in terms of the different types of diligences, first is business. Everybody wants to get comfort in terms of growth in a business, especially a country like ours, the kind of growth that we have. So whether the products or the services that a company is offering, what is the growth potential? What is the market? What is the pricing potential? That's typically covered as part of the business diligence. Second is the accounting and the financial diligence, which a lot of us are familiar with in terms of looking at the books of accounts, looking at what is the recurring earnings of the business, what are the liabilities over there. Third is in terms of legal diligence. Now, legal diligence will typically cover any kind of disputes, looking at the contracts, compliances, titles. The other important thing in a lot of transactions is what are the implications of change in control. So that is the third one. Fourth is in terms of tax diligence, any kind of tax liabilities, continuing or discontinuing tax benefits. Then is human resource. Human resource in terms of compliances, what kind of benefits that a company is offering. The entire organization structure itself. Is the organization structure in line to meet the future growth of the company? Compensation plans, whether they're in line with market or not, or there'll be an increase in compensation as soon as the transaction was to take place. Other thing which is really becoming important right now, and nobody better than Anil knows about it, in terms of technology diligence. I'm sure all of you have heard about the number of cyber attacks, ransomware, all that's taking place over the last year or two. How safe is the tech to be able to?
Atul, I think your internet connection seems to be blipping.
Of the business in terms of environment. Yeah. Sure. Okay.
Atul, I think you're.
Just give me.
Sure. Relax. Yeah. No worries.
Let me just change my location. Just give me 30 seconds. I'll just change my location.
No problem.
Yeah, I'll just change.
So MPV, this is really interesting. I mean, what he's kind of pointed out is that there are several kinds, as I may want to call it, of due diligence coming up in the market, and especially for chartered accountants or for valuers who it seems to have an amazing amount of potential in terms of business practice or in terms of chartered accountancy practice. So you could actually look at simple business due diligence and stuff like that. So it's an amazing opportunity, seems to be. Yeah, Atul, I think, are you back?
Yeah, is it better now, Anil?
Yeah, it's much better.
Okay.
Much better. And because there is some little bit of sun coming behind, so if you just want to,
sure.
just see you a little better. Yeah, that's it. We are seeing you better now. Thank you.
Seeing me better? Yeah. Is it?
Yeah. Perfect.
Sorry for this change in location.
No worries.
Every few minutes is just, I guess, issues
this is perfect. Perfect. This is perfect. No, I think so. I think Atul, we heard you, and I think what you pointed out is something really interesting, that there are, people are really getting deep down into due diligence. So it's no longer just a financial and a tax due diligence, which historically I think all of us, at least as chartered accountants, were used to. It is actually getting much deeper into it, and people are expecting you to do business due diligence, even expecting you to A, look at technology, and B, look at, even if you're on the other side in a new tech company, how are you protected, whether the businesses have the potential to destroy itself, or is disruption a likely to happen, and stuff like that. I think while financial due diligence, I think more or less all of us, I think being chartered accountants, have some idea about, might be very interesting if you could understand a little bit about business due diligences from you, right? And
sure.
And if you could maybe just highlight a top 3 or 4 things that somebody should think through when they start doing any business due diligence. And today, I think businesses are coming out in plenty. So how does one tackle it if you're new to the business, or whatever comes to your mind? Yeah.
Sure. All the disruption that we've seen over the last year or so. So if I give you a classic example, something like EdTech or education technology. Now, 2 years back, how many of us thought that there'll be potential in this business, right?
Absolutely.
Okay.
Yeah.
Okay. Over the last year, if we see the valuations of all the companies that are there in the edtech business have just skyrocketed. Right.
Fantastic.
And
I've also got one more interesting question for you. I just
right.
wanted to make sure that I remember that, so I interrupted. But yes, please go ahead.
Yeah. So now, using that as an example, now what's important is, even in edtech, one needs to look at as to which are the sectors which will grow. Right? Is it going to be people who are looking at the K-12? Is it higher education? Is it going to be professional education? Is it going to be kindergarten? Which are the sectors or subsectors which are going to grow? I can sit back and say, edtech is going to grow, but it's not that all fields within edtech will grow, right? So what a business diligence does is focuses on what is the growth potential of each of the specific businesses. And when they're looking at these growth potentials, it looks at the service offering, it looks at the geography where that business is based out of. It looks at the pricing, okay, and it's not only the current demand, it's this thing, and on top of that, in terms of the specific company. So one is the entire market outlook. Second is, how is the individual company placed in the entire market? Does that company have the wherewithal to grow faster or slower than competitors? That is that company just going to be a me too? Or does it have some special, uniqueness to it that it will grow? So that's simply put what a business diligence does.
Fantastic. So I just have an interesting, before MPB gets onto it. There's there's some WhatsApp roaming around. I'm not sure if you've kind of captured that, is Zomato valuation because of technology, or it is because of this 100,000 delivery boys that have been in the network and delivering food to people. So there's been a WhatsApp going around. Zomato does not produce food. It does not have a restaurant, but it has this 100,000 people who deliver. So when you get into an organization like this, right, which fundamentally is supposed to be a tech organization, but the network on the ground is so solid, required. For example, the Ubers of the world, the Zomatos of the world. How do you really go and do a valuation or a due diligence of something like this?
Right. No, that's a very important point on it. I'll just spend 2 minutes on that. One is look at Zomato's value proposition. What is the value proposition? There, it's getting the food from the restaurant to the house. Now that's not the only thing. If one goes to the Zomato app, it gives you the complete menu of the restaurant. Now, if I can put a small thing like masala dosa, right? It'll give me the list of all the restaurants, including the speed at which I can get the delivery. It'll give me the rating of the customers. Okay, so that's the technology interplay. Now, restaurant, just taking any name of a restaurant, ABCD, restaurant. Now they can have their own delivery boys, but do you get all the options in one place along with the customer ratings? You don't. So that's the technology interplay. That is what is special about a Zomato. Second is in terms of the entire delivery commitment. Okay, that is the second thing, which kind of places out a Zomato. Third is just from a business intelligence perspective. Now, is there growth that is expected in this market? Now, that's an important point. Look, if you look at one of the recent articles that came in the Ken, and I would request all of you to look at that. The population in India, which will subscribe to these premium products, is how much of that will really grow. or has that plateaued? Now that's an important call. Which one needs to, because that is going to demand the relief. That is going to drive the demand for this thing. So that is one part of it, is in terms of growth. Second is in terms of who are the competitors. If I look at in most of the new age companies now, in India, fortunately, we've been, over the last 7-8 years, we've had a lot of these companies. It's Zomato has got probably only Swiggy as a real competitor right now. There were a lot of other companies. If you remember, there was a Food Panda that came in. Okay, there was Uber Eats, which had come in, and there were a whole last year now. I'm sure a lot of us have even forgotten some of these names that were there. So where does Zomato stand amongst competition? That's the second thing which is important from a business diligence. Third thing is, now from an investor perspective, which is a real $1 million question. Will it ever make money? I don't know. Yeah. Okay. I would, having worked with some of the other companies in the sector, my sense is there is potential that the money can be made. Okay. People will get used to it over a period of time, and people will pay both customers as well as the restaurants will pay the premium. So that's my belief. No, absolutely. So I think those are the three things which one needs. Yeah, and I think you're very well put it. But MPV, a question to you. You remember our discussion that we had a couple of weeks back in saying that every tech company starts with a model, but eventually the model still comes back to the brick and mortar business model, right? A 5paisa.com started, and now it's India Infoline or whatever, IIFL. It's of course a large company. Similarly, are we expecting the likes of Zomato, and Byju is a fantastic example, right? Byju started with a model which is high-tech model, etc., etc. It now acquires all on-site, on-premise classes and gives some amazing amount of valuations, right? Because somehow these companies have the ability to generate cash, so and money and investors. So what I'm trying to get something like this, right? I mean, you try and value high tech, but eventually you go back to the same brick and mortar, of course, with some maybe differentiators. Yeah. So Anil, excellent question. I would say ultimately it's going to be an omni-channel strategy. It's for any of the tech and brick and mortar. There's going to be an interplay. You look at, if I just step back, if I look at all the vertical consumer internet companies, and when I say vertical, means focusing on any particular sector. So let's just step back. Let's look at a company like say Lenskart. Great solution. You go to the internet. You can select, what a particular eyewear looks on you. Which are the designs that you want. At the same time, they've now set up a lot of stores. But there's a significant play between what is there on the website and their offline stores, because the customer can see the entire product catalog prior to going to the store. The time that the customer spends on the store is much lesser. Customer is made up his mind when he goes to the store. The store becomes more of a fulfillment channel, as we call it. No, well, absolutely. So I think there's a great interplay between both of this, and this is something that during the due diligence, I'm sure one must be looking at in terms of what is the intersection of all the businesses. But yeah, back to you, MPV. I think you've got some technical questions up your sleeves. I was just trying to make sure that we get the business aspect of this right, because sometimes you simply don't understand what's happening where. And I'll just spend 30 seconds more. It's important because, again, we are a high growth economy. We are 8% growth GDP. For when an investor looks at India, an investor doesn't look at is not going to be happy with a 10-12% growth. In India is a market where investors want a 20-25% growth. That's what countries like India and China give excitement to investors. So that's why this entire business aspect from an India perspective becomes extremely important.
Absolutely. Yeah, back to you, MPV.
Thanks, Anil. It was very engaging and interesting discussion. So just borrowing one point from the exchange between yourself and Anil Atul. So when you do this business due diligence, you talked about EdTech space. Now, if you look at what's happened in China a couple of weeks back in terms of a regulatory change. Now, as a person who is doing a business due diligence, how much would you factor in developments like that globally, where the probability of something similar happening here is also pretty, I can't say remote. I don't want to say high, but certainly it is not remote. So how do you go about that?
That's again a very good question. So when one does a business diligence, one should keep in mind in terms of what are the regulatory changes that are anticipated. So China has a great point in terms of everything, in terms of education becoming not for profit, right? In our country itself, we've got various regulatory models, like for example, B2B, B2C in the consumer internet space itself that we have, which one needs to keep in mind. If you look at the tax changes, why look at China? Look at the tax changes. In terms of the retrospective tax changes, what has happened a couple of days back. Now, a few years back, whenever transactions were happening, people were getting so worried, looking at all tax issues which are even more than 5 or 6 years old. That these are changes which could impact the company from a retrospective perspective, right? But that's changed, right? If you look at any other sector where there are regulatory issues, it could be insurance, okay, it could be broadcasting, okay. So these regulatory changes one has to keep in mind while doing the due diligence and the implication of that on the valuation.
Sure. No, very helpful. Only thing for me, societally as a country, we have always seen education as a non-profit activity. And suddenly I see so much of valuation around EdTech. I really don't know where it will eventually settle down. That's a different conversation for a later time. Let me come back quickly to our due diligence related discussion.
Yeah, but I'm not sure, MPV, if you would have seen students in Japan, for example, and I'm just saying this, that while traveling in one of the trains, I could see almost every student carrying a nice iPad and really like a third standard, second, third, fourth, fifth standard. And everything that they were probably trying to do, some of their homework or whatever, was all tech driven and a very high tech driven kind of an environment where they were able to do that. So surely there is an amazing amount of mix. But I'm saying, how do you do a due diligence for something like this? I mean, I'm saying Atul, of course, has a fantastic experience, and I'm coming back to our members here, MPV, and I'm coming back to our registered valuers and our chartered accountants here. Atul has a fantastic experience in the Valley or whatever, and he would have probably seen there, done that, been there, at least must have had an opportunity to visualize something, right? How does a chartered accountant here have the ability to go and even visualize? I mean, yeah, otherwise it's all hearsay, right? India, 8%, 10%. I have not seen more than 5% GDP growth. But how does people like you and me do this here?
Anil, we have had this conversation earlier, Anil. My view, if somebody wants to value a tech space or a pharma space or any other space, fintech space, I think the valuer needs to know the industry and the economic environment, micro, macro, and global perspective fairly deep if he has to put his hand into that valuation. Otherwise, my view should stay away. Like, for example, if somebody wants to do a tech valuation, if he is not having his eyes and ears and research on what's happening in China, what's happening in the US, what's happening in Japan, if you look at different economies, different stages, there's some societies where education for profit is acceptable. There's some societies where it's not. I think somebody needs to have the deeper understanding.
Sure.
Without
Sure.
understanding, I don't think people should attempt it. So
Sure.
coming back, Atul, 2 points again from the business due diligence, and you so beautifully explained it for us. One is particularly in M&A transactions from an acquirer perspective. How much of emphasis is given or a value adjustment is also considered for a cultural diligence? For example, my little experience, most M&As have been successful where the cultural integration has been the best. Otherwise, on spreadsheet, on model, I think the best of the professionals have come together and put their minds. So there's no way it can go wrong. So if they've succeeded, it's because culturally the leadership has been able to ensure it happen nicely. If it's failed, it's because the leadership has failed to make it happen. So how do you go about identifying that, putting a value for that? What are your thoughts on that, Atul?
That's a very important point, Vijayji. And if I just step back, there's a new field of diligence right now, which is called environmental, social, and governance, ESG. Now, whether it's private equity or for M&A, that's an important piece, because people are looking at, whether the company with whom they're doing a transaction fits the requirements from an ESG perspective. Now, leaving that aside, as you rightly said, most M&A transactions fail because the cultural integration doesn't take place. So what's important is, for the investor, more so for the acquirer, to see as to, what's going to be the fitment of the acquired entity. And more often than not, why does the fitment doesn't take place? Because of people integration issues. All of us are human beings. All of us want our space, want our importance. And this thing. So it's important that, one, to give the respect to the acquired company, to have a plan in mind as to how this company is going to fit into the particular into the combined setup. Okay, so 2-3 things that are normally done is, in the start itself, you look at roles and responsibilities of the members of the acquired companies, that there is proper fitment that is taking place. So, for example, if I'm acquiring a company, say in the US, right? Now, you need to ensure that from a cultural fitment perspective, it shouldn't be that all the Indian habits are put away. Those people will do well in their own setup. For example, in the US, small thing in the US, typically workspaces would be 200 square feet for a particular person, right? India, we are 60 by 60, 80 by 80 at best. Now, you need to let the people work. This thing in the US, since a lot of time people have had this thing of work from home, right? You need to encourage that. You can't say day one everybody has to come in office, log their fingerprints in, otherwise you don't get paid, right? If there are designation differences, so be it. Okay, as long as one ensures that the people within the acquired companies are given their space, they're given their targets, and to whatever extent required, allowed to maintain the brand identity, you'll do well.
Yeah. So Atul, just another question on the categories of due diligence. My experience is particularly when it comes to funds and all, while you have the ESG due diligence, which is coming up now, HSE due diligence, the health, safety, environment practices. I think a very important due diligence which is coming up is on the FCPA or the PCA, the Foreign Corrupt Practice Act or the Indian Prevention of Corruption Act. So that due diligence I see as a very stringent one, and most of the funds giving a very high weightage to that. And some of the questions, Anil, are very sensitive, like for example, you need to give it on a sworn affidavit that have you ever gifted to anybody, It's particularly for organizations who are not exposed to that, where you could have very, just because it's a Diwali, you would have shared customary, a sweet box.
No, absolutely, absolutely.
And there's a journal entry in your books saying that Diwali time, sweet boxes were distributed 300 rupees each for so many people. And the whole transactions fall flat, So, it's such a serious one,
Yeah.
Maybe I think you can share some thoughts on it for the benefit of all.
So before Atul goes on this, and because I'm sure people have follow-up questions on these aspects, I just wanted to rewind a little bit, Atul, and you said, and MPV spoke about a very, very interesting thing is about the culture fitment. And I have seen 80% of the M&As go fund because of the cultural fitment, right? Eventually, what they wanted to achieve together did not come through because of a lot of reasons. One product mindset would be different, another product mindset would be different, and all of that put together. Does this become an integral part of your due diligence at any point in time? And do you allocate some weightages to this? When you go in to do a due diligence, and if it is from an M&A perspective, would you comment about this in your report, and you would give some? Is there a methodology around this?
It is. So, there is a specific. So there are two fields. One is you've got somebody who is looking at what's going to happen from a post-merger integration perspective at the time of the diligence itself. So in terms of in terms of roles, responsibilities, in terms of what all are going to be the cost takeouts, in terms of where there are new customers wherein you can enhance your revenue streams. So all those categories are kind of laid out at the time of the pre-acquisition diligence itself. Okay. And then you keep on working on those as you go into the post-merger integration stage. Okay, so let's just step back. When a company is being acquired, the diligence has to focus on three fundamental things. One is the valuation. Second is in terms of anything to be taken in the transaction documents, in terms of representations, warranties, indemnities, etc. Third, and most importantly, is in terms of post-merger integration and synergies. These are the three pillars, I would say, one has to keep in mind when you're doing any diligence.
Fantastic. I think that really helps. I think you having highlighted the pillars because the foundations are important. So, no, thank you so much. So we'll of course go back to those questions again, but I think let's take what MPV had on his table. Yeah, MPV, sorry.
We have some very interesting questions coming up from the participants. I will pose them to you now. Request in the interest of lots of questions which have come. If you can have some rapid fire answers, we can accommodate as many questions as possible. And just for the benefit of members, I see many of them asking questions around DCF. We have already done a program on that. My request is you could access the recorded version, or we will see if we can run one more program on DCF, considering that many of you are asking questions around that. So coming back on this, Atul, the member's question, I'll read it verbatim. One of the key outcomes of a due diligence report is normalized earnings view. Is it fair to equate it to pro forma EBITDA and add back future-oriented synergies or cost savings, calling such actual costs to be non-recurring, especially when such savings or synergies come through the acquirer only? And should seller get a price multiple based on such inflated pro forma EBITDA?
Fantastic question.
A very good question.
Fantastic question.
Again, so I'll just focus on this. So supposing
And so that depends on which side of due diligence team you are in, right, Atul? Am I right?
Yeah, so absolutely.
I'm getting it right, MBB. I'm getting my valuation fundamentals right, man. Yes, Atul. Back to you.
So you're absolutely right. I think good question. First, let's just take a practical example for the benefit of everybody. Simple example: you have to both the acquirer as well as the company that's being acquired have got offices in the same area, right? Now, one office will need to be let go as part of this acquisition. Assuming both of them have got enough spare area in their respective facilities, right? So one particular office will need to be let go. So when the acquirer does the diligence, they take in the value, the savings on account of these costs in their normalized or in their pro forma earnings, right? I would say pro forma in their pro forma earnings. Now, whether the benefit needs to be given for this in the valuation or not, as Anil said, that's a negotiation. Okay. Now, in today's date, where the M&A activity is so high, and in specific sectors where there are more buyers than sellers, you'll probably give the benefit because you just you want to maximize whatever is this thing. But in a year back when we were in the midst of COVID, then you would have probably not given that. You would have not given that benefit. So it was a buyer's market at that point of time. The other thing, keep in mind, it's always in a lot of ways when it's a listed company acquiring versus a private company acquiring. Listed company always is whatever savings I have, I get a price multiple on this.
True.
Okay, I have already got if I'm at a 15x multiple, I'm acquiring a company for 10, doesn't matter. I'll give that benefit because anyway, whatever saving is there, I'll get a 15x multiple on that in my own. So just that's the other psychology that people keep in mind.
So if I were to summarize what you said, Atul, was that for this question, the answer is fundamentally one, whether it is a buyer or a seller, one could definitely look at opportunities of either savings or product enhancement or rapid to the market in certain section of the market. Drive back that valuation as a merged entity could be sitting in either listed entity books or not listed. If there is a value attached to that saving, the line can be pushed towards valuation in terms of what one would like to negotiate. But from a due diligence report perspective, when you go in for a due diligence, I think the question was more that how do you account for in your report? Would you consider it and show it as a potential opportunity, or that is something that you would not do conservatively?
So no, we can show it. We can show it. This thing. Look, in a diligence, what's important is that you should be able to validate the cost savings. So what we'll say is that these are the potential cost savings, and what's the calculation behind it.
Perfect.
Now, the important part is as an advisor, as an external firm, when I'm doing a diligence, I would put some caveats around this, that this is based on management representation, that this saving would be achieved. Whether they are actually able to kind of, close that lease or not is something that I cannot vouch for. I cannot validate, right?
So would it be right to say, Atul, that as a due diligence expert, our role would be more to ensure that have we done some kind of validations around these assumptions? Absolutely. And are these assumptions backed by good data points? And whether those data points in our analytics and analytics make some sense. And if they do, then what you're saying is that you have no issues about putting it in the report with adequate disclaimers around it, is what you're trying to say.
Absolutely. And you need to look at it from a completeness perspective. Using the same example, you close a lease facility. If there's a lock-in period, who's going to pay the liability for the lock-in period? Is it going to be the seller or is it going to be the buyer? Please keep that liability also in mind. So you need to, so from a diligence.
So MPV, what I learned from Atul is, unlike a valuation and a fair valuation, a due diligence has enough amount of flexibility built into this entire aspect, where one would have to evaluate and validate things, but there is no kind of a standard to say that I will not do this, I will not take this. If there is an opportunity, you would do that, validate it, and come back with some response on that, saying that yes, possibility is there, and these are the elements behind. Right, Atul?
Absolutely.
Okay.
Absolutely. And at the same time, look at it from a completeness perspective.
Okay.
As I said, look at it from the liability side also. Don't restrict it only to cost savings.
Got it. Yes, back to you, MPV. I think that was a good question.
Actually, a scope definition, Anil, actually, when it comes to due diligence exercises.
Right.
So coming back, Atul, the next question, which is a very interesting question. When entities migrate from the SME platform of either BSE or NSE to the main board, you are required to submit a due diligence certificate to the stock exchange. So how different is that due diligence certificate compared to financial statements which are audited, or a due diligence on the financial statements?
So that's something which is typically done by the, and correct me if I'm wrong, is done by the, I'm not an expert in that, so I may not have the correct answer. But my sense is that
we can park it, Atul. I would actually prefer that we park that if you haven't dealt with that situation, because that's a highly SEBI and stock exchange.
Exactly. So that's I would rather.
It's park that. I would prefer that way. The next is a very interesting question. Actually, I also wanted to ask, the main aim of investor, the member says, is predominantly to identify any unrecorded liabilities. Thus, due diligence becomes an investigation exercise. How does one balance between investigation and diligence exercise?
That's a very good question. It's the classic issue of when we have whether the auditor is the watchdog or a bloodhound, right? If I just go back to what we've all learned. Thing is, it all on a serious note, it all depends on the type of company that you are looking at acquiring. If you believe that there are a lot of hidden liabilities in that company, then the focus of the diligence has to be in terms of, first thing has to be in terms of all kinds of hidden all kinds of liabilities which may not be disclosed, right? And these could be ongoing legal cases. This could be potential customer claims. These could be employee claims. This could be these could be regulatory issues. This could be vendor supplier related issues. So it all depends. To answer short answer, if one suspects from the while looking at the company itself, whether in terms of the financial statements or whatever one gets to know from just knowledge in terms of outside and knowledge of the company, that there are issues in that particular company, then the focus has to be first in terms of getting a complete hold on the liabilities, whether disclosed or not, and then doing anything else. So the important part is any diligence, given the time frame that you have, you need to be focused. If liabilities is the big thing, again, not to name anything, but if one was to do a company on any of the any diligence on one of the closed, say, airline companies, right? The first thing I'll go and do is that the business is not running. I have to first go and see what are all the liabilities that are there. Then I'll look at what is going to be the business potential of that company, right? I have to first say that what is going to be an immediate cash outflow.
Yeah. So Atul, two adjacent questions, Atul. One is as far as these liabilities are concerned. Let's say there are unrecorded liabilities and you come across in your due diligence. are there any professional responsibilities to communicate it to the regulatory authorities? If it's a listed entity, am I supposed to inform SEBI? Am I supposed to inform MCA, etc., etc.? Or sometimes I'm a chartered accountant bound by code of ethics, and we have something called non-compliance with laws and regulations, some principles laid down in our code of ethics. Of course, that part we are yet to make it mandatory. So are there any responsibilities which somebody has legally to report to various regulators, or as a firm, do you have some guidelines to say that, yes, I did the due diligence, I came across these things, which I know is public is not aware, I need to bring up. That's one adjacent question. The second question I have, Atul, is, I'm sorry if some of these are very sensitive, but all members are practicing chartered accountants, young registered valuers, and I would like them to gain the experience from your vast hands-on experience. The second question, Atul, is, see, we have these provisions and contingencies. So whether it is AS 29 or Ind AS 37, provisions comes into books, contingencies remain in the notes. Now, there is a judgment involved in that. What is the percentage of cases where you would have come across, where you felt that it has been shown as contingencies, probably it should have been a provision. It would have impacted its profitability, its net worth, etc., etc. So what is your experience around that?
Sure. So I'll take the second question first. I mean, as you rightly said, a lot of these are judgmental issues. Now, one may a contingency from a normal business perspective, maybe a contingency because chances are that that this may not result in liability. So typically in a diligence, what we do is we do a PPR test. What is probable, possible, remote. Remote being chances of that.
Probable, possible,
remote.
And remote. Okay.
Okay. So typically remote will not even come into contingent liabilities. Neither will they impact valuation. Probable, in all likelihood, will be a liability which will be there in the financial statements, for which there will be an adjustment, right? Where it becomes debatable is the possible aspect. Okay, that is typically either you see in the contingent liabilities, or if in certain cases, the alternative call based on past experience that this shouldn't come in the contingent liability. So that's where and I'll give you practical examples. Now, in the past, we've had things like service tax issues, which are fairly old, and disputes which are going on. Now, there, at least what I've seen, most buyers take a view is that one, based on industry knowledge, whether that liability will come up or not. So if they feel that the liability will come up, they take an adjustment. If it's something which is, chances are there, but it's like 50-50, what people will do is they will take some protection in the transaction documents, or they will make an escrow for a certain number of years, 2 years, 3 years, whatever. Liability comes, well and good. It'll be adjusted from the escrow, because it's not being adjusted from the purchase price, and there's a fixed amount which is sitting. Okay, so answer your question in a diligence. Yes, you need to look at all the liabilities, and it's pretty common that what the diligence, the view that the diligence agency may have could be different from the auditor's view. Again, there's a lot of times there's no right or wrong. It's a matter of how you treat that particular issue. It's as simple. I'm not saying the auditor is wrong or the diligence agency is correct. It's how you treat it. So that's the second point. First point is where it becomes a little bit more sensitive, I would say. More often than not, a diligence report is a private report. Okay, it goes to the it's a report which is addressed to the buyer or to the board of directors of the buyer. Now, in most cases, at least that I have seen is, and we've advised our clients is, please take a legal view whether this needs to be disclosed to the regulator. That's a legal view, which there is thing. There's no unfortunately I'm not able to give you a clear answer on that because it's absolutely it comes in the realm of what what the legal advisors will kind of decide.
Yeah, but MBB, what's our MBB? Do we have a stated view on this at the institute?
See, it's actually a question mark, Anil. Actually, it's a question mark. When we debated on this code of ethics, we have this non-compliance with laws and regulations which are there. What it basically requires is, as Rakesh was mentioning in his opening remarks, a profession, particular licensed profession, is something where you have those code of ethics. You have those responsibilities. So if you come across any such violation, you are required to bring it to the attention. So my view, it's early days is it. But I think the profession has to gear up to handle that situation. And sometimes I think materiality thresholds also are to be defined. Firms' individual policies also have to evolve. So to be very honest, I don't think we have a defined view on that now. But
I mean, anyway, this is a subject for a discussion other than this. But I'm saying if we were to constantly do this, why would people want to come to chartered accountants for anything other than auditing? Yeah. So yeah, of course, this is tricky. There's no doubt about it. So anyway, we'll leave that for a discussion on the consent table.
It could even apply through the SEBI guidelines for merchant bankers as well. So it's not going to exclude even. Like for example, if you take the Satyam one, it was the investment banker who blew the lid. He blew the lid actually. So it all depends, So they were regulated by SEC guidelines and they had to blow the lid. So it depends. So I think we should have one conversation on that.
Absolutely. But I just wanted to ask a connected question to Atul while you asked him about the liabilities. I'm sure when you're doing a due diligence, you also need to look at the top line or the revenue aspect. So the difference between a forensic test that you would do to a due diligence test that you do for ensuring that the numbers are right. So could you throw some light on that as to how do you perform those tests for the benefit of our members?
So, Anil, great question. When you're doing a due diligence, you look at everything from 3 or 4 viewpoints. One is just from a accounting policy, whether this complies with GAAP. Second is, I'm talking about financial due diligence. Second is from a commercial aspect, like one of the questions that was raised in terms of what's the recurring cost, what's the sustainable revenue and the cost, right? That's the second perspective. Third is from a forensic or a skeptical perspective. Whether does this expense seem okay? Is it does it seem very high? In any particular period, is it that that there's some leakage that's taking place or something like that? Or similarly, this particular customer, suddenly the sales are spiked. Okay, whether this thing or classic case where again in internet companies in the good old days, it used to be. One used to do those checks, are they common buyers and sellers and stuff like that? Is it you say that a lot of sales are taking place during night hours and stuff like that. So one has to wear. So
let me ask you a very pointed question, Atul.
Sure,
since you've done so many due diligences, right? On a scale of 10, how many books are really clean here?
I think the important this thing over here is that over the last so many years, India as a market, a lot of transactions are driven by the investment bankers. More often than not, investment bankers do a lot of homework before they get a transaction.
All right.
Before they pick up a transaction. Similarly, most investors have now become seasoned investors. So even they do quite a bit of work by way of talking to people, by way of doing their own background checks before they really get into before they really get to the formal diligence stage. So tough to put a complete percentage to it, but I would say, look, it's not like every second case you'll find forensic issue, because as a country we have also evolved. Our governance norms have also really evolved.
You're saying that times are better, a lot better than what we would have probably seen 5 years back, and because of this investor mindset and valuation, even the new generation which is coming in is keeping the books pretty clean and straight to the extent possible is what I'm getting a sense of what you're trying to say. Right.
Absolutely.
So yeah, MP, back to you, MP. I think there are a lot of questions coming in. So yeah, back to you, MPV.
Atul, the other element as far as the due diligence is a concern, now we have a requirement mandatorily under the Companies Act as well, not just in SEBI, for whistleblower process. Now, while you do the due diligence, how much of weightage or what is the approach you followed for ascertaining how much of whistleblowing activity has happened, or the company's own internal process of encouraging whistleblowing? And thirdly, in your experience, when there is a potential transaction emerging, do you suddenly find people coming and blowing the whistle and sharing some information? What are some of your experiences?
Sure. No, I think great question. So, typically, first thing what we do is we'll ask a company whether they have a whistleblower policy or not, right? And that's the first check that one do. Second is one does go through in terms of what all issues have been raised by the whistleblower, and what are the steps that the company has taken to address those issues. And we look at if a formal report has been done, if this thing, and most companies with a high level of governance will table these to the board, and along with the remedial action that has been done. Answer your question in terms of while the M&A transaction is taking place too, it does happen. But look, one has to be a little careful about these things, because some of these are genuine, some of these could be just may not really have an implication in them. So they do this thing, but the important thing is any of these kind of issues or whistleblower complaints. If the company doesn't have a good system, then I would say it is an issue as to why the company doesn't have a good system for having a complete detail of all these whistleblower complaints. The policy has to be.
A few more questions from the members. Maybe we can try to answer a little fast, because lots of questions are there. One is systems audit part and parcel of this due diligence and eventually for valuation? So I think our focus here is ultimately, as a registered valuer, I also need to rely on due diligence. So in that context, is there an interplay?
No. So systems audit is this thing. It's part of what I refer to as technology diligence in the beginning. So two aspects, two implications. One is if there's any one-time expense to be incurred to kind of strengthen the systems, that's an adjustment to valuation. Second is if they are recurring costs to be incurred. So, for example, if some new tools or some new software needs to be purchased on a recurring basis, then it'll impact the earnings as such.
No, I think the question also meant that do you do some system checks when you're doing valuations, especially maybe for a large entity or whatever? Would you actually do those tests like an auditor does to ensure?
So that is done by a specialized technology team. Yeah. Most investors or buyers will use technology. It's not. It's like somebody like me doesn't have the specialization for that, right? Sure. I'm a financial person, right? But you have people who are trained. So it is there.
I got that, but if I were to just extend this and stretch this slightly, sure. When you were doing financial due diligence, would you do technology control reviews to some extent, or no, you would only have an interplay of the data and do analytics and do external facing checks and stuff like that?
So it's the latter. Because okay. What one has to be careful is that they are specialists for everything.
Correct.
There are a lot of things which one knows about, but unless you have a specialization, it doesn't make sense. You could go wrong.
Perfect. All right. Yes, please.
Atul, there's a request for suggesting any good books on due diligence, which will be helpful for people to learn, if any. At least to be very honest, I haven't read any, but if there are any happy, if you can list them.
It's a very good point, and sorry, I'm smiling, but it's a very good point. If I just step back, in India, all in all, there'll be, give or take, there'll be like 1,500 people odd who will be presently doing due diligence full time, financial only, for a living. Then you'll have, when you look at lawyers do other things along with the legal diligence work. If you look at tax professionals, they'll be doing other things. It's other than financial where people are doing full time due diligence. There's technology, HR. People are doing other things also. So there's not that much. And globally, though diligence has been around for a while. There's no book. Second is, diligence, unlike a lot of other things, you cannot have a prescriptive or a checklist approach. It requires a lot more experience to be able to look at a particular account. If I look at pure numbers, to look at the trends in the numbers and say, this appears to be okay. There seems to be something amiss over here. And the other thing is, how do you relate it to industry, right? So there's no answer your question. There's no book. There's a lot of guidance that is there, which is there in.
Opportunity MPV for you to write one along with Atul here. Yeah.
I was exactly thinking on behalf of Valuation Standards.
Yeah.
Okay. So the next question, Atul, is this is again a very interesting one, maybe tough one to answer also.
Sure.
So if a valuer does his due diligence on the offer memorandums, various memorandum documents which are there, prepared in the past, he would find 40 to 50 risks which are outlined by the bankers, by the merchant bankers. How does the valuer decide on risks to be considered, ignored in the valuation exercise, and how does he include that eventually in his valuation report? For example, one is the offer memorandums, and if I were companies like us who file US filings and all, even in our annual findings, we have a laundry of risks which we give. In fact, if somebody reads all those risks, I don't think somebody should invest as well. So I think his question is, how do I filter it out and identify those which I should include in the valuation? And if I'm including or excluding in the valuation report, how do I communicate?
So again, this is more of, I would say it's more of a valuation thing, but more of a valuation expert would be able to give a better answer to them. My 30 seconds on it is the person's experience. And there he'll be able to take a call. A lot of these are standard caveats that come in. You look at any offer document, even if you look at a, for example, in the US, companies have these 10Ks and 10Qs for their quarterly and the annual reports. You'll have a lot of risk factors listed over there. But I would say it's the experience. But again, I'm not the expert on this.
Okay, appreciate that. So the other question is, what should be the key focus area in due diligence on behalf of a private equity on a target, and due diligence on behalf of an existing company who wants to grow through acquisitions?
It's a great question, and I'll spend a couple of minutes on that. Again, my experience with private, let's look at the second case first. If it's a existing company which is in the same field, and they are doing an acquisition, one, they understand the sector very well. So from a business diligence perspective, they need limited help. Second is in terms of synergies and all, a lot of work the buyer will do on their own. Third is standard industry issues, whether it's legal, tax, people issues. They will factor those in. So the focus for the diligence agency would be more in terms of are there any liabilities, are there any non-compliance issues, or things like that. And that's typical. There could be cases where an existing company is looking at getting into a new country or a new sector, then they may ask you to go whole hog. But in most cases, if it's a person in the same field, they will have a more focused diligence. Again, when you're doing for private equity will focus a lot more in terms of the business itself, in terms of the earnings, both from revenue as well as this thing, and they will look at all the legal aspects and things like that. The other thing which a private equity will more often than not look at is that when they are to exit that company after 4 years, 5 years, or whatever, 3 years, what could be the issues that could be raised at that point of time? So you need to keep that filtered. So, long story short, private equity diligences would be in terms of focus more often than not would be wider focus. A corporate would be more specific.
Thanks, Atul. Anil, with your permission, we may cross 2-3 minutes after 1:30.
Yeah, please. Yeah.
Brilliant 6 questions.
Okay.
The 4 are a little basic, but the next 4 are very interesting, actually. The first 2 are more from a conceptual one. The next 4 are, these are from the members, from the participants. The next 4 are highly practical one. The first one, Atul, is difference between due diligence, audit, investigation.
Fantastic.
Atul
combines all 3.
No. So I think it's a good question. First, again, look, all 3 have got are very, very important. Let's not, all 3 are very important. Whether it's an audit, whether it's a forensic, or it's a diligence. All 3 are. Let's not. I think a lot of times people undermine the importance of it. Please don't undermine. Okay. For a good diligence, you need to, if the audit has been done well, it'll always support. You'll be able to do a good diligence because that's a starting point. Okay, of the diligence. Now coming back to from a technical perspective, let's just step back. What is the main aim of the audit is to have true and fair view of the financial statements, right? That's the overall view, whether it's, whether it's, disclosures, whether it's qualifications, whether it's, level of detail that you want, but it's true and fair audit. Second is in terms of due diligence. Now, due diligence, and I'm talking about financial due diligence. Financial due diligence, the aim is look at the sustainable earnings and sustainable earnings, sustainable cash flows, sustainable assets and liabilities of the business. These are the three things, right? The reason why it becomes difficult, different from an audit is that, simple example, if there's a one-time write-off that's taking place. In an audit, you'll take it as an expense. In a diligence, you can add it back saying that this is a one-time thing. Normal case, this will not happen. So look at the earnings, adding this back, right? So that's a diligence.
So just to repeat that, you said a one-time cost in an audit would of course be expensed out, but you might want to add it up in a due diligence because it's normalized. You're trying to normalize it. That's what you're perfect.
That's correct.
Yeah.
That's correct. Another example could be that you've had a one-time income, an insurance claim has been received. Right. Now, is that going to be something which is going to be recurring or not? So you need to remove that from the earnings. Right. I won't get into details as to there could be a cost also to the insurance claim, but let's park that aside. So that's the diligence. Diligence, keep in mind, it's the sustainable earnings and cash flows. Perfect. I'm just focusing on this because everything relating to working capital, capex, everything goes within cash flows, right? So that's the focus of the diligence. Third thing what we talked about was investigation. Investigation is a deep dive into whether there's any forensic issue in the company or not. Diligence is not a forensic exercise. Okay. Correct. You may come across forensic issues in an audit, in a diligence, but it's a specific focus area. So all these three things need to be looked at separately. They are again interconnected and flow into the ultimate valuation. But all three are important. All three have to be looked at separately.
Thanks, sir.
Fantastic.
The next question, and probably I'll attempt to answer it for brevity. Can due diligence be part of forensic audit and all? Forensic, I think it's a word which is highly used liberally. It's very liberally used, unfortunately. Forensic actually is meant largely for gathering evidence to be established in a court of law. I think we should refrain from very casual usage of the word forensic. In fact, I am preempting this for the reason that many forum I come across people saying that forensic should be part of the regular audits which are done. I think those are very dangerous conversations which are there. So I'd like to conclude this part here. Due diligence is all about, as Atul explained, about sustainability, about validating whatever inputs have already been given. Somebody has made a presentation saying that these are 10 things, I'm validating those. So it's all around that. That's why I don't think we should treat due diligence and forensic anywhere closer. The next
Thank you. I think that's a perfect answer.
Yeah.
And, thank you for stepping in.
I'm so sensitive about this word forensic, Atul. I keep hearing everybody saying that audit should be forensic and things like sometimes it actually hits on my nerves. I get so scared that tomorrow an auditor has to embrace forensic as part of a annual financial statements audit. It's so dangerous. So that's why I get very.
No, absolutely. You're absolutely right. One has to be careful. Next question. These cannot be frivolous terms.
Yeah, exactly. The next question to you, Atul, is from a member. Can we put this in a sense that savings expected as a result of the transaction can be further validated by due diligence?
It can.
Okay, great. Does due diligence help in determining what is right valuation method to be applied to a given opportunity? Very involved question, Atul. I'll repeat once again. Does due diligence help in determining what is the right valuation method, DCF or comparable transaction method, whatever, to be applied to a given opportunity?
That's a very good question. Let's just step back to our first question. The interconnection between diligence and valuation. Diligence will give all the inputs for the valuation. It may, at times, after looking at the entire company, one may just say, look, instead of valuing this on the earnings, let's just value it based on the assets. You may come across that kind of this thing. Or one may say, instead of, it's initially the investor may have thought that a multiple should be applied. You say, look, it's just too early stage. It should be, a multiple may not be the right way. We should look at DCF in terms of, a diligence will give the inputs. It's ultimately the valuer who will take a final call. This diligence, they need to be, they are two specialized things. And I think, one can get the inputs from the diligence, but the valuation expert has to take a final call.
Penultimate question, Atul. How is the scope of due diligence determined in different scenarios? Does time limitation impact the whole scope of due diligence?
It does. I'm very happy somebody asked that question. Because more often than not.
Unfortunately, we don't have time, but excellent question. In fact, I'm so grateful to the participants. The kind of questions they ask actually helps you learn the subject more.
Absolutely, no, absolutely, and I can say so. It does because if you've been given a week's time, a lot of times people come and say do it in a week's time, and you have to say, okay, you give me, I'll do whatever you give me, whatever information you give in 4 days' time, I'll process that. Next 2 days, I need to do my analysis, and one day I need to keep together for the observations. So that's where, again, the good point. That's where a lot of times in terms of difference between an audit and a diligence will come in. Because an audit is as per guidelines. You cannot take shortcuts, right? Or you can't. Shortcuts is not the right word. I take that back. But in a diligence also you can't take shortcuts. But in an audit, you need to follow all the prescribed methodology. You can't keep it focused on certain aspects. Diligence, you can keep it. You can have a specific scope.
Fantastic.
Last question, Atul. Have you seen differences of opinion out of due diligence outcomes? What is the approach taken to address these conflicts? For me, these last 4 questions were excellent questions, actually. And this is the last I have for you today.
No, absolutely. No, it's again a very good question. And, that comes up all the time. But diligence is, for example, the same example that's becoming in terms of cost savings. Now, I may feel that the cost savings can be achieved, right? A second person may feel that the cost saving may not be achieved. Similarly, things like one-time cost. Now, I may say that a bad debt is a particular bad debt is a one-time thing based on whatever analysis we've done. The other person may come and say, no, it's it's something which is going to be regular in business. How can you know that 2 years down the line the company may not have a similar bad debt? So you could have different opinions. That happens all the time with us. We could have different opinions, but at the same time, in most cases in transactions, the buyer or the investor will take a balanced view and say, look, this seems reasonable, and his own advisor will come with something which is absolutely radical. The person on the sell side will come with a completely. You have to take a balanced view, and that's where again it's the experience which helps, right? When you've done this for so long and intuitively it looks okay, and you say, okay, let's take a balanced view rather than getting into that battle later. Let's try to solve things to the extent they can. A lot of times things are just here for negotiation.
Absolutely. Yeah.
You take something, leave some. So that's it. It is a transaction at the end of the day, right?
Exactly. So superb, Atul. It was personally very nice interacting with you. Thanks a lot. And over to Anil. But before I hand over to you, Anil, there were many questions from members. They were saying that we are a young member. I want to learn this. How do I? Every subject matter expert is saying that I've relied on experience, etc. But I want to gather that. Maybe we should think of one program where we can address those offbeat questions. I'll leave it to you, Anil, to think through, because
I think a good way to do this MPV would be, and a good start in my mind would be for you to write a nice book on due diligence, along co-author it with Atul, and I'm sure it'll become a hit. But yes, I do understand, and of course that was on the lighter side. But yes, I do understand that there is a need for our younger generation chartered accountants to probably rub through the experience of some seniors, and of course this comes through dirtying one's hands and not really comes in a classroom, which is a fact as well. But definitely this is something for us to ponder upon, MPV, as to how do we create a platform for these young chartered accountants.
Anil, you have been a great champion of game-based learning theory and learning and all. So maybe some workshops, some case studies, some simulation-based situations where the younger members can get exposed with some case studies. That might help. Maybe we should think through something.
No, we could, and we'll do this offline. But MPV, yes, we could, and I think that is a great opportunity for us to, help our members come up the curve quickly, as I may call it, because while the opportunity is huge, and I'm sure Atul's hands are full, there's so much for our chartered accountants to go out and do, and we need to, of course, create a scalable model within the country as well. When we're seeing so much of investments coming in, and also maturity around our businesses, which are likely to have more and more M&A transactions in the future, right? 10 years or 20 years back, nobody would look at a small Indian company for an M&A transaction. And this, I believe, is likely to happen more and more. And due diligence and valuation both would come into play in the next 5 or 10 years, I think. So again, it's a fantastic opportunity. So thank you so much, Atul. I think I really liked your answer around the differences between the audit and the due diligence and the forensic, and you put it very, very well. And I think the only thing that you did not put it up in so many words was ability to cut across all these 3 lines with a lot of experience. One needs to understand auditing fundamentally and has to have a business approach to a due diligence more, and also a little bit of forensic approach to ensure that what is on the paper is right. And one more thing that I probably learned was normalizing a lot of curves. So it could be your top line numbers, it could be your liability numbers, it could be one-time hit or whatever. So the more you try and approach it from a normal run the business kind of a cash flow, which makes it more sustainable, is I think also a fantastic output that members would have got towards due diligence. Of course, we did not have enough time to deep dive on various technology or new business aspects of due diligence. How would somebody really approach, for example, a new company coming in and try and do a due diligence around that? I'm sure we'll find another day to probably deep dive into it. But thank you so much for being with us. I will, of course, ask Sarika to do the honors. But again, Sarika, like every speaker, I would again request you to reach out to Atulji and see if we can create a knowledge base around this and publish something around the due diligence specifically, because there are lots of due diligence opportunities on the table. And we would want our chartered accountants to be able to do this very, very well professionally, because again, we want to walk this thin rope very diligently. Because it has ramifications on both the sides. So thank you, Sarika, once again. But back to you, please.
Thank you, sir. Thank you so much. You took my line of what I just also wanted to thank him for differentiating between this due diligence, audit, and investigation. Actually, due diligence is part of all the processes, be it audit, be it valuation, be it investigation. Due diligence is part of all this. It is not a separate thing. So, but we take it separately because it is a gamut of all the processes which we carry out. So thank you so much, sir. And I will connect to you for definitely bringing out this booklet. Not more than 56 pages, but yes, we will cover up startup, M&A in a small paragraph or small crisp manner. We will capture this. I will be in touch with you, sir. Thank you, Bhandari sir. Thank you, MPV sir. Thank you, Segal sir. And thank you, Atul Mehta sir, for sparing your time. Next week, we'll be again, let us see. If we'll come at 11 o'clock. 12 o'clock was only for today, sir. Thank you so much.
Thank you, Sarika.
Thank
and
you.
I just as a passing remark, I think because of the audit and the forensic getting all jumbled up, maybe MPV, you have another profession coming up very quickly. You might have to rewrite our standards around auditing very soon, the way that the regulators seem to be expecting this to happen more and more. Yes, Sarika.
Well, we have given one more task to MPV sir to do it. Government has already given some. Government
Fantastic.
has introduced for LLP standards, accounting standards for LLP.
Recommended by ICAI. Sarika, I don't get very enthused by a lot of standards, but I might want to clap this for MPV because he is the standard setting body within the country. But less the standards are better is always my mantra to MPV. So maybe after MPV spends another 5 or 10 years on the standard setting, and when he wants to come close to retirement, he would probably think through what I'm talking to him about, demystifying all these standards and creating a very simple standard. But anyway, thank you so much and congratulations, MPV. I think this is a fantastic task that has been entrusted to you, and I'm sure, as usual, you'll do a fantastic job around it, right? Yeah, thank you, Sarika. Thank you, Atulji.
Thank you.
Thank you, all the viewers.
Pleasure.
Thank you.
Thank you, participants. We have more than 2,000 today again. So thank you, all of you. Thank
So
you,
I think
sir.
consistently we have more than 2,500 participants, Sarika,
Yes, sir.
which means that these are the people who are really keen to understand valuations, due diligences, which is really, really very good. And I think our story and the Netflix series continues, as I keep saying to Rakesh again and again. So
only
fantastic.
last point would like to add on. There is a code of conduct for registered valuers, which is forming part of companies' registered valuers and valuation rules. Please kindly refer that code of conduct. You are a chartered accountant, code of ethics you need to follow. Definitely, there is no way out. But being a registered valuer, you have to follow this code of conduct also. So this is forming part of law. Kindly follow that. It is available on ICAI website. It is part of rules. So kindly follow. What are the liabilities have already been given as 247. Registered valuer is a concept under Companies Act. So all the liabilities, all the powers and duties that have to be taken care in Companies Act would be applicable to registered valuers. Do follow all in letter and spirit. Thank you so much.
Thank you.
Thank you.
Bye.
Thank you. Bye-bye.
Bye.
Bye.
Thank you, sir.